So for those of you who obviously long-standing clients of Nedgroup Investments, you would know that the Nedgroup Investments Stable Fund, one of our largest funds in the range, the benchmark is inflation plus 4% over rolling 3-year periods, while also trying to make sure that we can protect your capital over rolling 12-month windows. And of course, all of that with a maximum overall equity exposure of about 40%, which includes local and global equities as well. So joining us today, we have Nick Balkin, who is a portfolio manager on the fund. He's one of the multi-counselors on the fund. Nick, it's great to have you here. It's always fun listening to you and hearing your insights. And just a reminder to please send through your questions for Nick, and we'll definitely try to answer as many of those as possible. Nick, over to you.
Thank you, Anil. As you can probably hear, my voice is not 100% because I have a little bit of flu, so excuse me if that comes through. I think this was the year that I think the market grew up and realized that Goldilocks doesn't exist anymore. I think to see an 8% inflation print is quite an unprecedented number in a developed market. And the last time that happened actually was the US market was in 1981. It's a hell of a long time ago. At the same time, in that year of 8% print, the Fed funds rate was 12%. So it's an amazing dichotomy. Right now we've got the 8%, but we've got a very low interest rate. And I think the Fed have kind of planted the seeds for it by being too accommodative for too long. And in doing that, they've set the course for the high inflation. So what have they done? They've started to be a bit more hawkish, starting to raise rates. They were at 0. They're now moving interest rates in the US to 1.5%. And if you believe the Fed, they're on their way to 3%. And I think that 3% is still, if you think in real terms, it's not really that crazy a number. Especially if you think, obviously, 8's not going to last forever, and we'll see inflation come down quite a bit. We'll probably see inflation, at least it's implying that inflation will be in the high 2s. That means we're realizing and reaching a kind of normalized level for interest rates relative to the expected inflation, a slight positive real yield on interest rates. The problem is, as it says there, is that rising interest rates obviously are not good because for markets, because it kind of brings an end to the free money. And I think the free money led to those fairy tales that I speak about. And I think that the rising interest rates have now just focused the mind on bringing fundamentals back to world markets. And as you can see, that's why in this period, developed markets were down significantly, some markets down 16, 17%. The rand was blowing out, almost 11%. It's a huge number. So really unprecedented things in the market. And that's why I wanted to talk about a topic called harnessing inflection points. And I think that's something that's close to Foord's heart. To quote a person I don't respect too much, but has a really great quote, is Lenin, who said that there are decades that nothing happens, and then there's weeks where decades happen. And I think that's exactly what we're seeing right now. And at an inflection point, if you blink, it will be gone. Those 16% down and 20% down in world markets, if you're not prepared, you're going to suffer, and your investors are going to suffer. And Foord have always been about the downside, always been about protecting the downside, always been about maximizing the return, but also making sure that we don't lose money for our investor. So how did we do that? I think one of the most important things is you need to be prepared to be different. It doesn't help to be an ant following other ants off a cliff. You need to be able to think for yourself, and you need to have a real absolute mindset rather than just a benchmark mindset. So in doing that, you're able to focus on where the fundamentals are. And other important things, how we pick inflection points, is we understand the interaction between the different asset classes. We understand what's correlated, what's uncorrelated, and how we have offsets in the portfolio. The last thing that's very important in how we manage inflection points is having both a top-down and a bottom-up view of the world. We're thinking about the world thematically, and we're also doing detailed research on the companies below. And all of that comes to a really great formula for managing inflection points. If I talk about just the performance, I won't harp on it too much because I think you guys have seen it. I think we're quite proud of how we've performed over the quarter. Although it is a negative quarter, we don't like to have negative quarters. It all needs to be seen in the context of what I spoke about. World markets down. A lot of the assets classes were actually correlated, interestingly enough. So we're very proud of that. But more importantly, we're proud of the 1 year number of 3.2, and we're proud of the 3 year number of 7.7%, which is a very solid result in what is a very tough period. If I turn to the review of the different attributions and contributions and breakup of the performance, the last time I presented, I did say we were slightly disappointed with the first quarter, how it performed. I think the second quarter has come back much better on a relative basis. You can see that the heavy lifting was done by the foreign assets. Within equities, NASPAs also did perform pretty well, but the foreign assets were the big one. And that was Foord International Trust doing huge heavy lifting, especially in dollars, but once translated into rands also. And you can see that power of that diversification and how it kind of countered the negatives. We obviously also had a negative performance out of our bonds. We are on the slightly shorter duration in the 186. We've spoken about it quite a lot. It still was negative, unfortunately, but we're still very positive about that position. It's maturing in 4 years' time, and the yield is over 9% right now. So it's very exciting for us to own that as an investment into the future. But yeah, I think very, very solid quarter. And as I showed you, importantly, the 1 year and the 3 year numbers also looking pretty good. We have 33% in equities, which is also showing you one of the ways you can manage in an inflationary environment is to have assets with pricing power. So I think these are just a, picture graphic view of what I spoke about a little bit earlier. These are the year-to-date performances. Yeah, I probably should have color-coded it, but you can see, I would say, a sea of, unfortunately, green, but it's a sea of red in market terminology. Nowhere to hide, really. The two positives are the Foord International and the US dollar rand, obviously helping. And showing that the combination of everything, stable fund doing a slightly negative return year to date is, still very credible. If we now show that on a 1 year basis, you can see that the positive return out is stable. A big foreign weight in the portfolio has helped. Foord International doing very strong results. The other standout performer is the SA equity side of things, interestingly enough, over the last 12 months. But yeah, very credible results against what is a very tough market to manage. I'll jump to the next one. So hopefully I'll be a bit quicker, Anil, so we can have some discussion. But I think the Fed is in a really tough period right now. They, as I said, they didn't want to allow for cycles. They wanted to be very dovish. And now they're in a bit of a pickle in that inflation is high and they need to show their commitment to bring down inflation. But they're in this experiment where, to use another nursery rhyme analogy or story, they're trying to get to this not too hot, not too cold scenario. They're trying to fine tune that inflation is 3 right, is 2 right. The honest answer is they don't know, and they're kind of feeling and learning as they go along. And the problem is, although, as I said, to the implied inflation in the US market right now is the high 2s, the truth is probably nowhere near that. The truth is probably that inflation in the US will be over 4% if they don't do it right and they understimulate or they tighten and the market continues to be very stimulated, or they're overstimulated and they cause a really bad recession. And obviously then we might see negative inflation. So I think there's this very important dichotomy and management that the Fed are after. The important thing that I want to drive home also is that market valuations are not at pessimistic levels yet. So everyone's thinking, okay, the market's fallen almost 20%. Are we there yet? I can paint significant scenarios out there that really aren't good still. And the reason that everyone just thinks that this is the big one is they just haven't experienced these sorts of significant drawdowns. But if you look at the long-term market, PE, it's just pricey in the current long-term average at the upper bound of it. It's still really expensive as a US market when you look at history. So all I'm saying is this might not be maximum pessimism. If there are further things to come, you can see that obviously South Africa could be the collateral damage. Yes, we do see inflation coming down in SA. I did hear Laura speak about it. At the end there, we do think that we will see a normalization of inflation, but we're not certain if that's the case. So I think the key there is South Africa could be the collateral damage. We aren't doing ourselves any favors with the electricity, etc. And I think that's important to note that we are at the wall of world markets. And sometimes we forget about that. The bit of liquidity, I've spoken about it probably too many times. As soon as the liquidity dries up, they start seeing where the money really goes. And it goes always back to the place where they have the most security, which is what they know, which is the US dollar, which is the US system. So I think importantly, you can take away the market outlook is it has been a big drawdown. There are different scenarios where we can get better, but absolutely we don't think that we're off to the races just because we've gone down and valuations are at crazy low levels. I think you've got to also think about the context of a South African equity. We always talk about this balance between an equity and a bond. And when you have an equity, you need to compare it to the bond. And a 10-year bond is yielding almost 11% in rands right now. Now you've got to decide, do you go to a SA bond that you can get a secure, or you will get your 11%, or do you go into the equity market and take on equity risk? And that's the important interplay that we need to think about. For now, we think a very important building block are those bonds that I spoke about. They're there and thereabouts of where we were a year ago at around 37%. The foreign assets have crept up slightly. We have been buying one single corporate bond, which we think it's a South African listed corporate that has a dollar-linked bond, and it's a very interesting opportunity for us, and I think that has been one of the reasons that that's gone up. We talk about this 30 to 35% as a more through-the-cycle range for our foreign weighting, and I think that's where we are right now. I think money market is kind of where we funded a lot of the things, and as you can see, equities is largely in a similar place on the domestic side at 14%. Just ending off with a few interesting charts. As I said, we don't think we're off to the races. I think, excuse me, when you've got the Japanese Monetary Authority being the biggest owner of Japanese equities, that's not normal. And how that reverses, we just don't know. They're the last man standing in this fiscal pumping monetary stimulus base, and it's a great experiment to show why it doesn't work long term. Also on the US side of things, people think that there's still a lot of earnings power in the US, and there is, but we don't think that there's some sort of artificially low base. If anything, there's an earnings risk to the base. As you can see from the chart at the top right, you can see that savings rates are below COVID levels after benefiting substantially from the stimulus, and the US housing market is absolutely a long way from normality, still very expensive on any ratio that you talk about. So I think putting it all together, we need to protect. There still could be additional negative inflection coming through. Our job is to protect, making sure that we look after investors, finding the best returns at the lowest possible risk. We continue to focus on the downside. And we think that, importantly, if you manage those inflection points, that's really where the alpha is going to come from. And that's hopefully where we'll give the investor the happily ever after. With that very cheesy ending, I'll go to Anil, and hopefully we can take a few questions.
Okay, brilliant, Nick. Thanks very much. So there are a couple of questions here. Maybe we can try a bit of a rapid fire round. So firstly, how does the political outlook of South Africa factor into your forecast and the way you think about investing? So whether it's Eskom or the EFF, and there's a whole list, right?
Yeah.
It goes on. Yeah, how do you think about that?
Yeah, I think it's important to not throw the baby out with the bathwater both ways. So there's always going to be opportunity in South Africa also. Within any environment, there's always good and bad. I think the South African political environment does make it harder for us to get excited about the long term of South Africa. That's what I talk about. We can get a better yield if we push further out on the duration side of things on the bonds. But then we just don't know what plays out with the budget deficit in 10 years' time. So we can go a bit tighter there. But if we're being compensated to an acceptable level, then we can go there. So I think it's just about understanding the context of what return you require out of the environment given all those instabilities. I don't think it's changed since we've last met or for the last few years, actually.
Okay, great. So the next one is about the US economy and just kind of your perspective on the next 5 or 10 years. Do you think that's going to be the place to be?
Yeah, listen, it's predictions 5 and 10 years out is pretty much impossible, to be honest. But what I will say is America does tend to win long term. And they tend to win because they've got the right setup for the world. They have a drive for entrepreneurialism. They have a drive for business. And I think they're very... I think that all the ingredients are right to grow for the long term. Buffett always talks about being the luckiest man ever that he was born in the US because of all the opportunities that you get. Having said that, they've been very irresponsible with how they've managed their financial statements and balance sheet more recently, giving out free money, trying to keep everything going. And that's why we think, although there's a lot more stress in places like China, when you're at the $15,000 GDP per capita and you've got people getting smarter, the 10-year story is better for China. When you're already at the pinnacle, which is a very strong GDP per capita, you're going to be a lot slower grower. So I think that's what you'll get out of the US. Slow growth out of the market, and that doesn't kind of define what you'll get out of a market return, but the GDP should tick along slightly. The other last thing is that they do have a positive demographic, which is always an important thing for a long-term GDP.
Okay, great. Thanks, Nick. Just on the gold ETF, it was one of the contributors this last quarter.
Yeah.
So why not just hold more cash instead? And how do you think about cash versus gold?
Yeah, I think it's an important one. We've spoken about it a few times. I think what we say is that previously was kind of a free insurance policy because cash rates were so low. And effectively, whether you had the money earning next to nothing in cash or gold, it didn't really matter. I think we ask ourselves a lot harder question around that. But remember, it also protects against rand weakness inside it. So it contributed, but not because the gold price in dollars did well, but actually the rand blew out. And that actually did most of the heavy lifting. So we talk about it as almost a Armageddon insurance in a way right now, making sure that we're not getting bigger at all in its size. And if anything, through time, I think once it pays its dues, can get smaller, actually.
Okay, Nick, thanks very much. There's actually still a couple of more questions here, but we are out of time.
Okay.
Really do
I think
appreciate
my voice is out of time also. Thank you.
Really do appreciate having you. Thanks
Cool.
so much.
Okay, thanks, Annie.